Hello, everybody, and thank you for joining us for this week's NASDAQ Dorsey Wright Market Update called July the 20th, 2020. I'm Jay Gragnani, and here joining me this week is Steve Raymond. And, we kick off another week, another interesting day in today's trading so far. On Monday the 20th, we continue to see a pretty much mixed across the board out there with, the Dow Jones still down on the day. NASDAQ and S&P are both currently up, with the NASDAQ leading that charge, as a lot of technology from a sector perspective, as well as consumer discretionary today, performing well. But you look underneath the surface, and I say interesting day because you're still looking at a day where on both the New York Stock Exchange and the NASDAQ, there's more stocks that are trading down on the day than there are trading up, and the vast majority of the sector performance has been interesting, as you have more broad sectors, more S&P 500 sectors down today, with utilities down the most, and industrials, consumer staples as well, down about 1%. Nonetheless, as we kind of look at the market today, we wanted to bring a couple of areas to your attention. One, just as we often do here, is just kind of look back performance, what things did well over the course of the last week, what things have done well, over the course of so far this year, almost 7 months now into the books. We continue to see some positive developments on the chart of the S&P 500. We'll touch a little bit on that. Additionally, some areas of improvement, not only within equity, but you're continuing to see improvement from a number of fixed income groups. And lastly, looking at the small cap space, with small cap growth really outperforming value, and they've been, very, very big dispersion so far, and not only in terms of returns for small cap growth versus value this year, but also in terms of their ranking and their score, their fund score history. So with that said, jump right in and look, over the course of the past week, it was a generally positive week. The S&P 500 last week was up about 1%. But there was a number of sectors out there. There was a number of areas that were up 3, 4, 5% last week, and industrials and materials and healthcare, all sectors actually up more than 5% over the course of the past week, with only one of those, and that being healthcare, out of those three that are up on the year. And there's still just a couple sectors, technology right up there at the top, up 16.5% on a year-to-date basis. Consumer services up 7%, consumer discretionary up almost 7%, and then healthcare. Those are the four broad sectors that are actually positive on the year through Friday, so through the 17th. And another couple other interesting tidbits here is just to look. You saw some, somewhat of a laggard rally, if you will, last week, where some of those areas like industrials, like even small cap value, that have not done well this year, saw decent returns over the course of the past week, as some of those sectors bounced pretty nice. But nonetheless, technology really lagging last week quite a bit, holding down the S&P 500 cap weighted index just a bit, as that was up only 1.25%. With that said, on the S&P 500, we've seen some interesting trading here over the course of the past month now, and even today, as the S&P 500 has developed some resistance here, on the chart at 3220, and that goes all the way up to just about 3240. And even today, the market, the S&P 500 has tested that resistance and tested that resistance here in the high 3230s. Getting up to 3239. But one area, Steve, that I know we've talked about in the past is that 3240 poses a nice potential breakout on the chart of the S&P 500.
Yes, it certainly does. And quite frankly, we expect that would be the outcome. Keep in mind that your trailing alert is still at 3100. That would be a downside breach that could alert us that maybe things are turning another way, but certainly you would have no thought of any defensive either short-term activity or mindset, as long as those prices stay above 3,100, which they have been for some days, and now basically back to where we were in the June timeframe to break this top and foreseeably had to challenge the prior market highs. Back to you, JT.
Yeah, and so that's if we see, and like I said, we're intraday getting pretty close to that. So we'll see how the rest of the day unfolds, and it's you never know. As even last week we continue to see just big intraday swings in the market movement. As we're recording this here today, getting very, very close. So at 32.40 you get there, and then as you mentioned, Steve, I mean you're back looking at the February highs that on the S&P 500, that 20-point chart show back up to 33.80. So certainly continue to watch, but you've got some decent support now as the market has traded back and forth a bit over the course of the past month. But basically what we've seen is, consistent series of higher tops and generally higher bottoms, which has been very constructive on the chart of the S&P, very specifically on the chart of the S&P, but a number of equity charts, indexes look very similar to that. Speaking of, the S&P 500, one of the things that we have looked at quite a bit is, in the asset class group scores page. And so for those of you who are not familiar with that page, if you're logged into the website, you go to the asset allocation tab on the top of the page. There's a link to go to asset class group scores. And what this page is designed to do is identify leadership trends across the different fund groups that we evaluate. There's over 130 groups that you can evaluate based on their average fund score. And the page is going to default to this macro view. And so this gives us a really good sense from a macro perspective. So looking at big asset classes, big areas of the market that are often evaluated for allocation decisions. And Steve, as we look at this, the S&P 500 group has been one that has just been, a really, really tough benchmark. In other words, has been one that has had, a good high fund score for the better part of really, this year, but also, the past number of years.
Yeah, and that theme, continues through the weeks and the months that we're in basically after the market sell-off, the core dominance, has continued. And let me just reiterate that, the percentile rank of the core of the market is running around the 85th percentile against all asset classes around the world. That would be a very strong, dominant reading. Typically, I don't like to see it at 100 being the only leader out there, but the 85th percentile is a good dominance. And what I've noticed, or what we've noticed over different decades, is when you have a high core dominant reading, which 85 does qualify, it tends to, present smoother markets, a little more confident markets, and that is kind of a nice thing for, the asset allocation point of view, is that, the markets are stabilizing a little bit and the leadership in the core is still there. So typically we form asset allocations or look at ETFs or look at scores and tend to look at the core dominance first or funds that are relatively close to the core. And so running at the 85th percentile is a great reading. Now, on the other side of the field, the money market percentile rank is at the 25th percentile against all asset classes around the world. That would mean that the cash is outperforming or better than, or you should use cash more than, let's say, a quarter of the assets available to you. However, that leaves 75% of the asset classes around the world as functional, scoring well above money market and giving you a good potential return for the risk that you're taking. And we keep an eye on that level. The 25th percentile is still slightly high, compared to some readings we've seen in different decades. But it's in that, bottom quartile area where you could say that money markets often move from 0 to 25. But I would still say, in context over the last few years, it's still a little bit elevated. So it keeps us monitoring for those levels and if they change and how they change. If they do not change, then the core reading being a very high dominant reading and the money market being relatively lower, sets up a nice, at-risk, on offense type of approach for the asset allocation, certainly concerning asset classes, but as we'll delve in later, certainly including equity and fixed income and other things to which you would fulfill the asset allocation. So at present, we have a pretty good market offense, allocation offense, type setting here in the summer. In July, as we moved into what we call the seasonally weak cycle of the market's 1 year rolling period. We're in the weak cycle, but the market performances are still good. And certainly the core percentile rank of the market itself is showing a vitality here in the summer. And so that's a bit of good news. But again, we have to monitor it. You're welcome to monitor these levels daily, because we do update them daily. Many have a frequency where they log in and also check weekly or monthly, and certainly quarterly for models and other strategies that you would run. But the core percentile rank is consistently pegged at good percentile ranks, so far through the summer. And for all we know, we may expect to see that continue, but that's why we monitor in case things change. Back to you, JG.
Yeah, and one of the things that has certainly changed that we mentioned last week, but is relatively new, is that the emerging market area has seen quite a bit of improvement. You see that the emerging market group up there in the mid threes, which is certainly a positive sign for emerging markets there. But we mentioned that there's a lot more groups than just this macro view, and on that asset class group scores page, you have the ability to look at a number of different views, and one of those is just simply looking at all groups. So if you change the view to look at all groups, one of the interesting perspectives here is you can also sort it by the score direction. And, basically what that's doing is looking to see how the scores for those groups have been trending. Are they generally rising? Or are they generally falling? And Steve, we were talking about this kind of view, and you mentioned that, the basic material sector has been here, when you look at all groups, is the most improved group in terms of their score direction, with the score moving up just over 2.5 points. 2.68 has been the score movement, seeing that score get up into the threes.
Yes, the score direction is basically a month algorithm where we measure from a low point in a score to where it is today. That low point could have been a month ago, a week ago, a day ago, or literally 5.5 months ago. But the important point is I think, as JG mentioned, the market's broadening out here. You have more groups than I practically can count quickly that have a score direction, or you could say their scores have moved up more than 2 points or close to 2 points. This is a lunge, if you will, by some leadership groups, but in this case, some of the laggard groups, showing that they're improving in score, what I would say, rapidly, and giving you an alternative view, if you will, another list to look at that might be something different than just looking at a technology list. In other words, in this list, you have leaders, not necessarily in total score, but certainly in score improvement, and Basic Materials takes the lead of that list, punching up not only as the leader of the list, but you could look at the other tangent, which would be it also crossed above the score of 3 just in the last few days. So it did both. It crossed above the score of 3, and it's the leader of improvement in score. And so that makes it a good idea for you to go back, look at traditional names, possibly ETFs. IYM would be an example of an ETF that is in that crowd, in that space. But also notice other score direction improvers, massive improvers in China, in non-U.S., also convertible bonds and your corporate bonds, and there are other bonds in this list. As mentioned a moment ago, emerging markets is high up on this list, with 2.16 points in score improvement recently. And so as you go down this list, you'll notice that there's, in my mind's eye, a significant amount of fixed in groups that can help your allocation that are improving rapidly here, and a significant number of equity groups that can help you in your allocation that are also improving rapidly, including some small caps and micro caps, and so on and so forth, and biotech. So big score direction tells you that the market, or there's interest, there's buying, there's volume, there's money moving into these spaces, causing those scores to improve on the total system against all other asset classes that we measure. And so that gives you more, I think, opportunity to broaden out that allocation, which was probably a wise thing to do. Keep in mind that some have said that for weeks and months, the relative strength was narrowed and cornered into, one niche of the total market. And I would like to point out that though that is true, look at these other groups that are fanning into flame and trying to produce good scores as well, from the 3 area up to the 4 area, up a little higher. So the mixture of improvement is quite good to see. And I think that will be beneficial as you take a look around at some of these ideas and infuse them back into that allocation, so that you're not really holding only one bag of good stuff, but that you're diversifying around, not only through equity, but also through fixed income. And I'd like to say, the precious metals being in here, the basic materials being in here, does imply in some sense some commodity action, various, let's say, or personal commodity funds that you're aware of, monitor those scores, for how robust the particular score would be. And that would certainly give a good alternative infusion into the general allocation model, which I would say has been overweighted to large growth for a while now. But I think that we can say that there's legitimate reasons to certainly consider diversifying to other groups, and many of them should be the groups that you see here with the dominant score direction. Now, some of the score directions that you see here have been cruising to be better for a while. Basic materials would be an example of something relatively newer, where it just crossed up above the score last week of 3, and that improvement is a lot of that improvement is a July-based factor. So again, you have some older strengths, you have some newer strengths, but I think when you add them up, you have 15, 20 some asset classes that are distinct, that can help you go ahead and pick some good ideas and infuse them into do your current allocation. Back to you, JG.
Yeah, and you think about basic materials, and obviously you've got some of the metals, the metal miners that are in there, the chemical companies that are part of that, and then the commodity piece with gold, so something like a GLD continuing to do well, hitting new 52-week highs. But also, crude oil. Crude oil obviously had its bout of volatility early in the year. It has come back quite a bit, and it's trading, just north of 40, $42 on the crude oil continuous chart. So CL / is the symbol on that. But $42 would put that chart of crude back into a positive trend. So that's, just something interesting that we'll continue to watch and monitor as we move forward. But, one thing here that I wanted to drill in a little bit more is the small cap space. And small caps have been, for the better part of this year, a very, very volatile group. There hasn't been a whole lot there in terms of their leadership trend, but you can slice that, and you see it even here, a bit thinner, and say, it's really been the small cap growth has been the favorite area over small cap value. And just to kind of visualize that, if you look at small cap value, so IWN is the iShare Russell 2000 small cap value ETF, and compare that score to IWO, which is small cap growth. The score differential is almost 4 points difference now, favoring growth over value. And as the small cap growth has been among those areas that has been improving in score here of late, and improving dramatically in the case of small cap growth, small cap value is actually backed off a little bit. It's up off of its lows, but it's actually backed down. And after getting close to 2, it's still down below 2. So when you look at just thinking about small cap in an allocation, certainly the small cap growth segment of the market is the area that we continue to see the leadership trends prevalent in, and small cap value still struggles really across the board, and still struggling to get back into a leadership trend. Obviously, the past, call it 4 months off the market bottom. Everything is generally risen in absolute price, but within specifically the small cap space, it continues to be a small cap growth leadership trend there. And, we see that it show up in something like the Dolly size and style rankings as well, with small cap growth being in the number 3 position behind large and mid cap growth. So, the growth style is certainly something that continues to see dominance in terms of the relative strength rankings. And you see small cap value all the way down there on the right hand side, being basically the 9th or the weakest of all the style boxes. And that's nothing new. For the better part of this year, you see on the right hand side there that small cap value has been, for the past 12 months, has been either in the 8th or 9th position, and that's kind of been the consistent theme, where really the leadership trends, large cap growth up at number 1, mid cap growth still at number 2. Those took some turns going back and forth at 1 and 2 for a bit. Large cap growth has pulled away from mid cap growth a little bit there, and then small cap growth has moved back up to number 3. Large cap blend or core, they're basically for all intents and purposes tied right now with a tallied number of 129 with small cap growth and large cap core there, and that's large cap core. Think that's S&P 500, right? That's kind of the benchmark there, and then you get into most of your value stuff being down toward the right hand side of the rankings and being a bit weaker. So that'll just be a continued situation to monitor. At some point, value as a style, value as a theme will come back in favor over growth. And this is a great place to kind of monitor that, to see if there's any changes from a signal perspective, see if small cap value or even mid cap value is beginning to pick up signals versus some of the others. But right now we haven't seen any evidence that the value over growth theme has any legs to it thus far. So, but
JT,
go ahead, Steve.
If I could make a historical comment, what we see, I think, is exactly right. The small value has the lowest score of the style boxes. It's in the last rank of Dolly. I will point out, as some of us ask, well, who cares about small value anyway? Well, small value is actually, historically speaking, a massive performer. The key is when do we hop on board to take advantage of what I would call stellar performances that can occur in that group. Also, historically, there seems to be a diagonal relationship between large growth and small value, where you will almost never see small value, as a leader, and large growth as a leader also. They seem to be diagonal in their correlation, where one or the other would be in a strong leadership format. And so for those that are thinking down the road that large growth might wax and wane and fall out of favor at some point, that is a definite time to come back and see how small value is responding to that. And that could be, a time we'll look out for. Of course, as JG just mentioned, none of this evidence is piled in at this point, but it would be something that would be very important to catch on to if it occurs. I'll give you an example. As we came out of the 1999 through 2000 fall off in the market, that fall off was generally a large growth fall off into bearishness. And lo and behold, the small value did come up and be a number 1 style box in 2001 and by 2002, and ran for many years as a leader in the U.S. There were leaders outside the U.S., but in the U.S., small value was definitely a leader, and extremely helpful in keeping the allocation performing to be able to switch to that type of asset class. So, though we're saying that we don't see the evidence of any switch over from large growth to small value at this point, it still maintains a key concept to keep an eye out for, and a key opportunity that when it occurs, we must shift our allocations to that type of format. And let me remind you that if that were to occur, and if we shift, and then you shift also, which is how this works, the various compliance departments will say, hey, how come you're overweighting so much in small caps? Shouldn't you be overweighting in large caps, as the firms have espoused? And that's where you run into the tension of your allocation needs to be in a certain format, but that certain format is, in essence, non-popular amongst certain firms. So, you keep that in your playbook to say, hey, yeah, that's a play we'll run, but we're going to run it down the road. We're going to run it when the evidence comes in. And part of that evidence is excellent scores from small value and generally, historically speaking, fairly deteriorating scores in large growth. We're not at that juncture now, but we know what to look for. Back to you, JG.
That's great. Yep. No, thank you, Steve-O. And as always, as we, talk through these calls, as we put together content in the daily equity report that gets published through our website every single day, these are things that we will certainly be watching for and monitoring for in terms of potential changes that may arise out of the small cap value camp. Or other changes that might arise. And so, as always, we certainly appreciate you joining us for these calls and these market updates intro week throughout the course of the week. We are certainly available if you have any questions, comments, concerns. You can reach us at the phone number there or via email. And as we mentioned, every day there's content that is produced through our daily equity and market report, and that we will discuss these types of market actions, as well as provide individual stock recommendations, ideas, and other general market commentary through that daily equity and market report. So if you have access to that, be sure to take a look at that. If you don't, we do offer a free trial. If you'd like to come in, take a free trial of the service, and we can get a guided tour for the website set up for you as well. So with that, as always, once again, we appreciate you joining us this week. Very much value the time spent and appreciate you taking time out of your busy day to join us here today. So thank you again, and look forward to talking to you next week.